right. Good afternoon, everybody. I'm Jenny Ifft, Associate Professor of Agriculture and Extension Specialist in Agricultural Policy. Today, I'm going to be talking about what I'm calling high coverage policies, SCO, Supplemental Coverage Option, and ECO, the Enhanced Coverage Option. And the big point I want to make here is that they're really different than the standard 70-75% revenue protection that most folks in Kansas here and used to. They're pretty common. On top of that, we're in a high price, high volatility environment. Because of that, we got really new policies that work really different than what we're used to in this environment. What I'm going to do is try to take a step back and look at the principles of why people use crop insurance and how they decide, and sort of just slice and dice that decision in a lot of different ways to help people make a decision that works best for them. Also just want to say it is a challenging year to manage risk, but there's also some opportunity here. These prices imply that some farms can lock in a decent profit margin. Other speakers are going to talk about that more. But hopefully this presentation covers one component of the different tools and considerations available to do that. First of all, a brief overview of SCO and ECO. These are policies with a county-based trigger. Typically, it would be your own county, but sometimes you're looking at multi-county yields if you have a crop that's not widely produced, and that's going to come in a couple times later as a reminder. And you could think of SCO and ECO as either lowering your crop insurance deductible, that's the yellow here, or you could think of it as increasing your coverage levels. And with ECO, you can go all the way up to 95% of your expected revenue. With ECO, you can get either the 90%, that'll cover you from 86 to 90. If you get the 95% ECO, that's going to get you from 86 to 95%. Now your program choices, FSA program choices will matter for this. ECO can be used with yield or revenue protection. It doesn't have to be used with SCO. If you pick yield protection, you do get a higher premium subsidy for ECO, but it has to match your underlying policy. There also is a price selection option, which is available for ECO, which I won't be talking about very much, but for folks that are concerned about cost, that's something you could discuss with an agent. SCO is a little bit tricky. It can be used, actually there's a typo there. SCO can be used with PLC, but it cannot be used with ARP or any area plan or MPP. So you have to have PLC selected and no other area products for SCO. We'll fix that later. Next, what do SCO and ECO not do? They're not going to cover your own yield declines, assuming you also have some revenue loss. So it's possible to have a loss for your own farm or field and not receive a claim, depending on what happens at the county level. Also, this is a revenue product. You have to have a revenue loss. So let's say there is a large price decline, but if you have proportionate higher yield to the county level, you might not see a payment, although it'll still be a sort of an average revenue year, for example. The other thing, and I'm not going to talk about this too much, but if you want to forward contract crops that have a positive basis like sorghum right now, SCO and ECO aren't really designed for a situation like that. First of all, what I'd like to do is take a step back and looking at the different things we're going to evaluate these products based on. These are really the different ways you can make, based on the different ways you can make decisions about crop insurance. So the first one, this one is pretty straightforward. You want to minimize costs. And this is sort of more a perspective of how can I keep my crop insurance costs at a management level, or I know I have to have crop insurance and it's important, but I want to manage the costs. So that's pretty straightforward. We're going to look at the premium costs. The next one is cases where the revenue guarantee or yield guarantee provided by crop insurance might be important. And this is for operations, especially that might have some cash flow issues. So am I going to be able to repay an operating loan, make new investments under any price or yield outcome? You know, say you're considering an investment that could, at least in the short term, lower your working capital, make you vulnerable to cash flow shortages. In that case, crop insurance might be really important for that specific revenue guarantee. So For this, we're mostly gonna look at the liability or the revenue that's guaranteed by each policy. Also important to keep in mind is this county versus farm correlation in terms of yields and the payment timing for these. In terms of the payment timing, ECO and SCO will pay out in June of the next year. So for 2021 crop year, that's going to be 2022. So that's something you got to keep in mind if the guarantee is important and timing matters for you. Next is value. And this is sort of the perspective that if you want to get the best deal, this is a federal program, the federal government shares in the cost. How do I get the best value out of this? Now, typically crop insurance, the way it's designed, it should more or less be a good deal in the sense that the farmer should come out ahead in the long term, but there is no guarantee for this, and you do need to look carefully at the ratings or underlying prices. So one thing I've noticed in looking, now I'm new to Kansas and I've been looking at a lot of the premium subsidy rates, and you see that they decline from 80 to 85%, which reflects the risks that we have. But it is something you got to be a little bit careful about. And I'm going to look at a couple of different measures to think about this: the premium subsidy dollar amount, the premium subsidy share, and that premium to liability ratio. Next, you can look at crop insurance from an investment perspective. So how can you get the largest return from crop insurance in the long run? And so with this, we're going to look at expected returns. So what's the likelihood of getting an indemnity over time? What are typical amounts? And then we can also look at, in other words, net returns under different yield and price outcomes. Now, to use this, we're going to use a couple different examples. The first is Finney County for non-irrigated corn. So that's a 220 farm level APH yield or yield guarantee with expected revenue of over $1,000 this year. We are using current RMA prices and implied volatilities since they came out. This is slightly higher than the Finney County non-irrigated corn county level expected yield. That's about 202 bushels per acre. If you want to know for your individual county, we do have maps available at Ag Manager for you. Next, Marion County, we're going to have non-irrigated corn for an example. This one has 110 farm level yield guarantee, and expected revenue in this case would be about $500 per acre. Next, we'll look at non-irrigated sorghum in Scott County with an 81 bushel per acre yield guarantee with expected revenue of about $356. The last example will be Saline County non-irrigated soybeans with an expected, the farm level expected yield will be about 41 bushels per acre. So first, we're going to look at the policy costs. So what's the premium? Now, I do want to say for everybody, I'm going to go through a lot of tables and we're going to go fairly fast. I'm not going to read all the tables. I'm going to be focusing on the big picture. But if you want to get into the details later, the presentation is going to be online. Rich emailed it out. I'm also happy to take questions. Now, the different policy options we're looking at here. First of all, 75% revenue protection, SCO with an underlying 75% revenue protection. We'll look at 95% ECO with 75%, underlying 75%, and then both ECO and SCO. And so the big picture here is, wow, these cost a lot. That your premium costs can really vary a lot, whether you use an underlying 75% RP or you go to some of these higher coverage policies. So I think there's going to be sticker shock for a lot of folks. And there are, as we go through this presentation, I think hopefully you'll understand that these higher prices aren't arbitrary. They're reflecting both the prices and high volatility we have right now, as well as the higher likelihood of a payout. So we're gonna get there eventually. But just briefly, so Finney County for corn, you're looking at premium costs anywhere from $11 to an acre. versus 51 if you stack all these policies together. For Marion, $14 to $39 an acre. I am going to mostly be talking about enterprise units, but I did throw the optional unit costs here. So that'd be $26 per acre in Finney and $37 in Marion. So if you are using optional units, these high coverage prices might not seem so bad or might be more comparable to what you're used to, and that could potentially provide an alternative in how you think about using crop insurance. Next, policy costs for sorghum and soybeans. These are pretty similar. So in this example, non-irrigated sorghum, anywhere from $11 to $29 per acre, depending if you stick with RP or start adding on additional policies. Saline County non-irrigated soybeans, very similar range, $9 to $32 per acre. So how big are these costs is a question. So we can look at farm level costs. Here I'm using our Ag Manager crop budgets. These are based on November estimates, and I'm not going to get too much into the weeds with these because Greg's going to be talking about farm income next, but it does look like costs are going to be 10% or much higher than what I'm quoting here. These are just the latest regional budget. So they provide some perspective of sort of the wide ranges we're looking at here. And so if you look at, say, corn for Southwest Kansas, the crop insurance costs that we're looking at, they could range from anywhere to 2 to 9% of variable costs. And then if you go over to this example, non-irrigated soybeans in North Central Kansas, anywhere from 6 to 20% of variable costs for these crop insurance policies. You know, maybe a little bit lower if we have higher expenses, but the bigger point here is it's a wide range of costs. And if you get up to that higher end, your crop insurance in a lot of cases is going to become comparable to, say, your fertilizer. Well, not fertilizer is a bad example. Say your seed costs for soybeans. So it does become more of a major input is one way of looking at these policies. What about the guarantee? And this is simply the liability under these different policy options. I did put the liability under last year's prices to provide some perspective. So, you know, it's the guarantee under the same policy could be $100 higher per acre, more or less, depending on what you're doing. So in Finney County, this is for irrigated corn, you're looking at $750 to $950 range. Marion County for non-irrigated corn, $378 to $479. So really quite a wide range of guarantees that you can cover. Also, again, these guarantees for SCO and ECO, part of that's like to the county instead of your own yield performance or revenue performance. It's quite a bit higher than last year, though. So Scott County non-irrigated sorghum, you're looking at anywhere from a guarantee of $268 per acre to $339. For non-irrigated soybeans and saline, it would be $365 to $462. So you can see the impact of those higher prices there. So how does that compare to your bottom line? So here for each example, what I'm doing is I'm comparing your expenses, that's direct plus fixed. So all your inputs, cash rents, depreciation, capital costs. And what's really striking for me when I went through this is that 75% RP is relatively close depending on crops to your expenses. So, you know, 783, again, this is probably a little low, but you can take it in perspective. 783 for irrigated corn in Southwest Kansas compared to a 750 individual RP guarantee. And you can see similar ranges, say, for non-irrigated sorghum in Southwest Kansas, where that 75% guarantee is pretty close to expected expenses for the average farm. Then if you look at moving up to county level revenue protection, that additional coverage is really, it's really corresponds to the profit margins. So you could see it as one way of looking at it is that you're guaranteeing a higher level of profit. should revenue decline? The counterpoint to that, of course, would be that in a sort of an average or higher revenue year, that premium is going to take up a larger share of that profit margin. Next, the premium subsidy, and I'm going to look at this in two different ways. This is the share, and that is set. That's on the left here in purple, and this is just what's set by the government. So you're looking at 77% for RP and going down to 44% for that 95% ECO. So that's going to go down as you go up, but it does, the total amount of premium subsidy does continue to increase as you add on. So $32 per acre in Finney for 75% RP, another $24 per acre for ECO. And if you stack those at, $56, $75 an acre. Similar for Marion, $47 an acre at 75% RP, down to 13% for 95% ECO. And again, here's the sort of the cumulative premium subsidy if you're using more than one policy. Again, these percentages are the same for sorghum and soybeans. The dollar amounts are also comparable. So $35 per acre for non-irrigated sorghum, down to $9 for ECO, $32, $16, $11 for soybeans. And again, you could also look at how those add up. So all the way up to $59 per acre if you're using everything you possibly could. Premium to liability, that's another measure that gets at the cost of the coverage you're buying, what you pay relative to the dollar amount of what's covered. The higher this goes, it reflects basically the higher likelihood of an indemnity. So as you move from the 75% RP, well, it's 0.01 here in Finney County for irrigated corn. And we're going to look at this later, but you don't get below 75% of revenue very often when you're irrigating. But 95% that can happen. Coverage level, you're going to have indemnities a lot more. So that cost of that coverage is going to be higher. Here it goes from 0.04 to 0.35. I think generally talking to folks that work in crop insurance and agents, 0.33 to 0.35 is probably the max of what some producers are willing to take on. But that might be a useful metric for some folks. You can also average it out, and it sort of ends up being somewhere in between here. Similar numbers if you look at non-irrigated sorghum or non-irrigated soybeans, 0.04 to 0.34 and 0.02 to 0.34. So really pretty similar range across crops. To some degree, it does affect the underlying risk. So just sort of summarize, if you want to look at the value of crop insurance, are you getting a good deal or not? There's a couple different ways you can do this. You might want to look at more than just the share of the premium subsidy, though. But what's the big question? Will it pay? What's the expected performance of these new high coverage policies? Well, first we're going to look at history. And the payments are going to be based on expected yields. I have a map here for the corn expected yield for each county in Kansas for irrigated corn. And these are well over 200 in southwestern Kansas, and sort of lower in some other parts of the states. But I'm not going to get too much into these details here, but all these maps and other ones are available at Ag Manager. Here's non-irrigated corn. So highest yields in the northeastern part of the state, lowest in the southwestern, soybeans and sorghum. So what's the likelihood of an indemnity for irrigated corn at that 95% level? To get an idea of this, we looked at what's your actual yield relative to trend yields, which are pretty close to RMA expected yields, not exactly. So it's just to give you an idea of how often this might trigger, how much volatility you're facing in your county. But there's a handful of places that would get some payment almost every year. And there's some counties, say down here in southeastern Kansas, where you're closer to a third to a half of the time. So it's going to vary a lot by counties, and it can be anywhere from a third of the time to about 3/4, 3 out of 4 years. So one would expect that trigger to happen quite a bit moving forward.
Jenny, just quick, I had a question. Can you tell us how expected yield is calculated?
Not exactly. It's pretty close to trend yields though. In most cases, it's just a couple bushels per acre off. So it's the historic average with some expectation that the average yields are going up over time.
And I had one other one. Is this information available in writing so we can understand? Do you have a paper on that? I didn't think you did, but.
I haven't done a paper, but I did post the maps on Ag Manager.
And I was going to post the links for the maps and the tool.
Yep. And they're in this presentation, and they're also down here.
Okay, I have one more question. Are the grain prices used for the ECO guarantee higher of spring or fall, and fall crop prices the same as for the regular RP policies?
So for these estimates, we basically did these are calculated based off of revenue protection. So if the fall price is higher, we reset the guarantee to determine whether or not these would be triggered, which is how ECO should work in practice. So.
Okay, that's all I have.
Okay, that should answer the question, and I'm happy to either go in more detail or take it offline, whatever's best for people. So irrigated corn ECO 90%. I think the lowest we have here is that it trigger 25% of the time, but it can go above 50% in some counties as well. Next, irrigated corn with SCO. This is pretty similar to that 90% ECO, which isn't surprising. That's not that different, but these do range from 20% of the time to 50-55% for a handful of counties. So could be fairly often in some places. Next, let's look at non-irrigated sorghum for 95% ECO. It looks like you'd be getting indemnities on typically 4 to 10 years or more, depending on where you're at. Now, there is one caveat for these. I am assuming a county level guarantee here. And if some crops are not very common, RMA is not going to have as much data, and they're going to combine counties to get that expected yield. So that's something you can find on the RMA website or something to talk to your agent about. But that is a pretty important consideration. But again, if you're growing a crop that's pretty common in your area, they should be using your county level data. Next, non-irrigated sorghum. Historically, you would have seen 90% ECO trigger in about 1 out of 3 years. Again, quite a lot of variation across the state. For non-irrigated sorghum, SCO, about 25 to 50% of the years. But really these maps, and again, we have them for soybeans online. We're going to do them for wheat as well, and that becomes more relevant. But this is just whether or not an indemnity is triggered, not how much. So we also did a deeper dive into what's happening at the county level. And so this would be the estimated loss experience for Finney County for irrigated corn. And so what this does is year by year, how close is your actual revenue to our proxy for expected revenue for that year, all the way from 2000 to 2019 was the last year. So first of all, if you look at the years above the green line, that's when there's no payment, and there's 5 years. You have another 6 years between the green band and the red band, and that's when you're going to have a pretty shallow loss. So you probably going to break even, maybe get a little bit on ECO. And there's sort of, look at this between the red and the purple, or right beneath the purple. So these years here, you have 4 years out of 20, where your 90% ECO is triggers, you might get a really small SCO payment. Another 2 years where you have a small SCO payment. And only 3 years, this one's pretty much a wash here, but 2 to 3 years where your underlying 75 percent policy is going to make a relatively small payout, but again, all the other SCO and ECO would trigger in those years if you'd purchased them. And if you're going to go back and look at sort of the premium levels, one thing that was interesting, probably because I've been staring at this a lot, but if you go back and you look at the premium levels, they really do sort of reflect this experience. For example, 75% revenue protection in Finney County is one of our lower cost policies. For a pretty high value crop, it's $11 per acre. Well, with irrigated corn, you're just not getting below that 75% trigger very much. So that's reflected here. Next, we look at loss experience for non-irrigated corn in Marion County. So above that green line, you have 8 years where you wouldn't expect any payments. You have another 2 years where you will get some small payment, maybe from 95% ECO. Another 2 years where you'd get a small amount under 90% and a full amount under 95. And then look at this. So 86% to 75%. So if you bought SCO, you wouldn't have any SCO only years. But you would have, if you look below the dash, 8 years where you'd get your full SCO payout plus from the underlying policy. So pretty different if you look between irrigated and non-irrigated. Next, non-irrigated sorghum, we're looking at Scott County. So you have 10 years, no payouts. 2 years where you're gonna trigger full 95% ECO and also a pretty close to full trigger for that 90% ECO. Another 2 years where SCO would trigger, plus you'd get your full ECO payout. And then 6 years where you'd get fairly large payouts in your underlying policy, most likely, assuming some correlation, plus full SCO and ECO. Next, we'll look at the soybean loss experience. This is for Saline County, non-irrigated. So 8 years, you get no payout. 5 years, you're going to get some small 95% ECO. So you might get back your premium a little bit more per acre. 1 year, you'll get some SCO, it would be just SCO and your full ECO. But then you have 6 years where you would have gotten that full underlying payout plus, not the full underlying, sorry, you get some underlying plus the full SCO and ECO if you bought it. So I guess how big are these indemnities in dollars terms? So I go through some examples here of sort of more shell loss scenarios so you get an idea of the magnitude of potential payments for this year. The first case would be a 75% decrease in revenue. You could think of that, the price dropping 25%, that'd be to 341. And average yield. You could also think of the inverse, pretty bad yields, but sort of prices stay on track. In this case, your underlying policy doesn't pay out, but you get the full payout under SCO and ECO. So, for Finney County, you're looking at about $100 per acre. Your net benefit's going to be smaller, about $50 per acre in Marion County, sort of. A little bit less for your net benefit. And similar levels for Scott and Saline. These will be here for reference if somebody wants them. We also have a payout estimator for SCO and ECO and Ag Manager. So if you just wanted to play through a bunch of different outcomes for your own area, that's pretty easy to do with that tool. Next, what about a small price drop? So let's say the price drops to $4.09. There'd be a 10% decrease in price with expected yields. In that case, you would get some 95% ECO, not the full amount. So $50 payout. Finney net benefit at 20, 25 in Marion, and you net benefit at 9. Net benefits just your payout less the producer premium. All right, so similar situation for sorghum and soybeans. Next, what about a situation where you have a shallow county loss but deeper local yield losses. This scenario is really meant to highlight that that correlation could matter. So you're suffering pretty big yield losses. There are some yield losses at the county, but they're not quite as bad. So 14%, you're not going to trigger any SCO, and 75% policy would pay out at those levels, and you would get your full payout for a 95 or 90% ECO here. I think I accidentally switched those. Okay. Next, let's say you have 20% higher yields, but a proportionate yield decline, only a 10% revenue decline. So a 95% ECO might kick in here, but nothing else is going to. And this is just again to emphasize that this is revenue protection, and a price drop could be mitigated by above average county yields. So something you need to think about. So what about sort of, this is a question I got. Well, what about like, what about sort of the dollar amount? Am I going to get back what I pay in or more? And that's come up. So what I did is I looked at how often you would need to trigger these policies to break even on the producer premium. So where do you get to a point where the producer premium is equal to the indemnity? And I just did this using 2020 prices, commodity prices, and 2021 premium prices. These policies weren't available in previous years. So just sort of a rough example to give you a taste for what that would be like. Well, 95% ECO for the counties and crops that we looked at. If you wanted to break even, if you had actual revenue that was about 92% of your expected county every year, you'd sort of just break even, you get back your premium. Another way is that if you got the full payout, to get the full payout, that's where actual revenue is less than 86% of what's expected. You need to get that in more than 3 out of 10 years. So if you got a payment 4 out of 10 years, you'd at least get your premium back. And the specifics kind of vary based on what crop you're looking at. That's why I'm giving range. For 90% ECO, you'd want to see the revenue at sort of 89% or expect it a little bit less of expected county revenue each year to sort of break even or have it where your premium equals your indemnities. If you look at the full payout, so this is again a situation that happens when your actual revenue is less than 86% of expected of the county. You need to get that in about 3 years out of 10, depending on what situation you're looking at. For SCO, with the underlying 75% policy, your actual revenue, if you had actual revenue in the range of 84 to 85% every year, you get it back. But if you get the full payout in 1 to 2 years out of 10, you should at least get indemnities that would cover your premium costs. There are some additional considerations that I want to sort of just bring up very briefly. I think we're running a little short on time, but some of the premium costs I gave you are pretty high. So it maybe worth, if you're thinking about $10 versus $50 an acre, are there alternative investments you can make with $50 an acre that might be better for your operation? So that's, something, again, when you're thinking about that kind of money that might be worth it. Current and expected weather. This is something, to be honest, I'm still trying to unpackage, but folks might be concerned about La Nina or dry conditions. And it sounds like there's a lot of different factors that can influence these things, but they might come up. Another thing is a positive soil basis. Dan's going to cover this more, but just briefly mention, there are some private products that could help when you're forward contracting. There's something called APO that is a yield protection product on the optional unit that allows you to lock in a higher price. And there are other types of price risk management as well, futures and option, which folks are going to get more into. I was just looking at the premiums for those. So for corn, if you're looking at current prices, that's about 44 cents a bushel. And the crop insurance prices I talked about range from 5 to 35 cents per bushel. It's similar for soybeans. So your crop insurance costs are going to be lower on a per bushel basis than, say, using a put. Of course, it doesn't totally reflect the same thing, but you are looking at different costs there. To conclude, there's not one correct way to manage risk, especially when you talk about these high coverage policies. So there's not sort of one recommendation to make. It really depends on what the farm's objectives are. The two things I would say for these high coverage policies, it's helpful to take a long-term perspective, just how they work. You almost have to look at it like an investment. And also it's just something where you'd really want to do your homework, because it's a policy that works a little different, you know, to understand where it does and doesn't meet needs and where things could get tricky. You know, you do have to pay more to get more coverage. You're going to probably get frequent payments, but you could go several years without. So what does it look like if you're paying those premiums for 3 or 4 years and you don't get any payback? That could happen. And also just some cautions. Again, what's your farm level correlation with the county yield history? Farms that are sort of widespread and have a large amount of acreage throughout a county might be better off. That delayed payment might be an issue. Also just some disappointments. I think if you go back and look at that maps, there can be pretty different experience with ECO payouts just from one county to another county. So sort of like ARC and PLC, it's definitely a situation that I'd expect to at least cause some frustration. Another thing is those premium costs during average revenue years might seem pretty high. So it's something to factor into your decision making. A lot of resources on Ag Manager. Farm Doc has some good articles as well, more relevant to Illinois, but they provide a great background. I'm going to wrap up here. I have time for questions. Also happy to talk offline. Okay.
Jenny, this is Dan. You know, I know the cost of these is pretty hefty, no doubt. But if you look at the money they'd be spending for other forms of insurance, particularly out west with hail insurance and the Garden City area under irrigation, you know, then it's not all just added cost. It may be, you may be trading off things, particularly if you're talking about payouts of 30-40%. That's hail country out in western Kansas. You know, so I would wonder about yes, I know the base cost is pretty high for these added things, but if you buy up, again, it's worth figuring the marginal change in coverage and compare that back against the hail insurance would be at least one thought.
Yeah, no, I think so. Definitely. And yeah, every time. So I'm from Illinois and I lived in New York most recently. And every time I hear about the weather in Kansas, I get overwhelmed. So
we call that the hard water out here in western Kansas. So.
Yeah.